Interest of time, I think we will make a start. So, very good morning to you all. Thank you for joining us this morning. My name's Marie Wadeson, and I'm a managing director here at the K3 Advisory Group. And I also lead the K3 Hub, which sits at the heart of our relationships with the professional advisory community. I know that we've got a jam-packed CPD accredited session today for you, so I'm going to dive straight in. I think there is a slide on the screen which will tell you a bit more about K3 Advisory Group and K3 Hub in the meantime. So, a little bit of housekeeping before I get on to introducing you to today's speaker. So, as you will have seen as you've joined the session, we are recording today. This will be posted on the K3 Hub website on Monday. Q&A function is open. Please do feel free to ask questions as we go along. The preference is if you wouldn't mind using Q&A rather than the chat for your questions. It just helps Ros keep everything in the same place and know where to look. We'll be posting a PDF of the slides into the chat shortly, and we'll do that periodically throughout the session for any latecomers. We are aware that it's a very warm day and it's quite a long session, so we will be taking a couple of breaks. They will be there or thereabouts on the hour. Right, so on to today's session then in that case. So very pleased to welcome back Ros Martin, who I'm sure many of you already know from previous K3 Hub webinars. Just as a reminder, Ros is a tax consultant and lecturer. Over the years, her K3 Hub sessions have covered commercial property taxes, tax obligations for entrepreneurs and small businesses, and the tax issues relating to business structures. And I think it's fair to say that Ros's sessions are always enormously popular and certainly the speaker that draws the largest crowds for us. You will be able to view recordings of her previous sessions on the K3 Hub website, along with all of our other CPD sessions from across the last 18 months or so. Today, Ros will, as well as a review of recent tax cases, will be focusing on associated companies, loans to participators, loan relationships, and creating and breaking groups of companies. Just before I go, a quick word about a couple of forthcoming CPD sessions coming up, one before the summer break and the first one back after the summer break. So, 3rd of July, we've got AI for accountants and lawyers, and we'll be discovering how AI tools and well, we'll be covering off AI tools and how these can transform finance functions and legal teams. Then when we return on the 4th of September, we have an accounting issues update. Invitations are sent out on a regular basis, so do keep an eye on your inbox. We also promote the events on the K3 Hub website and on K3 Hub social media, particularly LinkedIn. So do give us a follow. All that's left for me to say is thank you for joining us. I hope you enjoyed today's session. And over to you, Ros.
Thank you very much. What a very nice introduction, and no pressure that my courses have been popular in the past. Anyway, we're talking about corporation tax issues this morning. Just to reiterate what Maria said, please do feel free to ask as many questions as you want. As say, in the Q&A box would be easier for me, but I will keep an eye on both. And if there are, I will try and deal with those as I go along. If there are lots of questions or things that are slightly off topic, then I will deal with those probably just after the breaks. So let's get started. Associated companies. So I think this is a topic that, firstly, I get asked a lot of questions about in my own consultancy business, but when I talk about it on lectures, I also get asked quite a lot of questions. So I think it is an area where there is not exactly confusion, but I think that the rules are certainly not straightforward. So why are associated companies relevant? Well, we know, of course, that from the 1st of April 2023, we had a change in the corporation tax rates, and we went back to a situation where we have a main rate of 25% as it happens now, where profits of a business are over £250,000. In general terms, we have a 19% rate for profits up to £50,000. And we have marginal rate relief between those limits, which means that roughly the rate of tax is 26.5% between 50 and 250. Now, certainly when I first came into tax and up until I think 2017, we had these split rates of tax. And so people will be familiar, I think, with the general principles. The rules this time round are a little bit different. And hopefully, without confusing you too much, I will talk briefly about what those differences are. Now, the real reason that associated companies become relevant is that if you have got associated companies, and I should also say actually that if you have short accounting periods, those 50,000 and 250 limits are reduced. Now, in respect of the limit in terms of associated companies, I think the real issue is that if you have a number of associated companies, the limits are split equally. So you can't decide if you have, say, two companies, one which has got, maybe a couple of £1,000s worth of profits. You can't think, okay, I'm going to allocate a couple of £1,000s worth of profits at the low rate to that company and then the rest to another group company or another associated company. It's equivalent, it's split, which means that you can get situations, particularly where you have significant differences in profitability. You can have situations where there is going to be problems caused, and so that is part of the issue. I think the other thing to say to sort of contextualize this a little bit more is that when we had different rates of corporation tax in the past, the limits were much higher. So in the previous iteration of split rates of corporation tax, although the rates of corporation tax themselves were higher potentially, the main rate didn't kick in until you had £1.5 million worth of profits. And the small companies rate actually applied right up until 250,000. So we had, which also then meant we had a much bigger transitional or marginal rate. But now those limits being lower means that in some ways we have less companies affected because more companies are paying main rates of tax. But for smaller businesses, it's not. It is something which is problematic. Now, the other reason that I think it's probably quite important to talk about this now is that we are starting to see compliance from the revenue on these issues. And I think it's quite interesting because we talk about the fact that, or I talk about the fact that I don't think necessarily people within the profession are very familiar with these rules. But I don't think the revenue know what they are either. So about a month ago, I saw a case with the revenue where the revenue officer was basically saying, yeah, these two companies are associated, and they absolutely weren't associated. And I'll talk about that particular case when we get to have a look at some examples, because I think it's quite an interesting one. And to be honest with you, not even marginal. So not even a case where effectively there is any nuance about whether or not they are associated companies. They are just absolutely not associated. So it is quite worrying that we could potentially have what is a fundamental piece of legislation which is not well understood by the revenue. Not my cynical view is that that's not a great surprise. But it's still not brilliant. And as I say, it's not an isolated incident. It's an isolated incident where they're quite so poor in terms of the actual understanding of the rules. But I'm being referred quite a few inquiries in relation to associated companies. So it's something clearly that the revenue are now starting to look at. Okay, before we talk about associated companies, just to mention one or two other things. There are some companies that always pay 25% rate of tax, so there is no nuance involved. Even if they have very low profit, they will not be able to benefit from the lower rates of tax. The first is any company which is a close investment holding company, which is covers all closed companies. Closed company, obviously, being a company that is under the control of 5 or fewer participators, and we'll talk about closed companies in a moment or in a little while when we talk about loans to participators. The permitted purposes are trading, property investment, with the caveat that not if you are renting to connected parties, and group holding or financing companies. So if you're a trading company, you're fine. If you're a property investment company, you're fine unless the property is rented to a connected party, and it is wholly or mainly that we are looking at in this situation. So if you had 2 companies, one trading, one separate company holding the property from which the trade is undertaken, and nothing else, that property investment company will be a close investment holding company. It will pay 25% tax on any of its profits. But if it's under common control, it will also be taken into account for the purposes of associated companies. So thereby reducing the available small company rate or marginal rate band available to the other company. So that is now not a particularly not particularly relevant. Now, somebody's asked the question, what is considered common control? That is what I'm going to talk about in a minute. So this is just to kind of contextualize this whole thing. So that is what I'm going to be looking at in a moment. So if we had a property investment company that had a huge property portfolio, but one of those properties just happened to be rented to the child of own a lot of student property, and one of them happened to be rented to a child of the main shareholder, that is probably not going to be enough to make it a close investment holding company, assuming that the portfolio is big enough and the wholly or mainly test is not considered. So that is fairly straightforward. I do get questions about close investment holding companies. Again, it's one of those areas where trading and property rental, the kind of 2, or group holding companies, and then anything else is going to be relevant. And we'll talk about holding companies again in a moment. The other point is that foreign companies are always going to pay the main rate of corporation tax. So if you have a company that is holding property in the UK and therefore subject to tax in the UK, or indeed is trading in the UK through a permanent establishment, then that will always pay tax at the main rate of corporation tax. And again, that is a point that people sometimes overlook. But as I've already noted, in both of those situations, the bit of an issue that you have is that they are still going to be associated companies. So they will potentially cause other group companies to have an increased tax rate. So when we are talking about associated companies, we do include foreign companies or companies associated for only part of the accounting period. And so again, you do need to take account of those. And companies only associated for part of the accounting period is also an area where people trip up, because actually you only have to have a company associated for one day in a common accounting period, and it will be associated for the whole accounting period. What you do exclude is dormant companies, and a dormant company is not, the definition dormant company is not particularly defined, but it is broadly a company that has no activities. Not necessarily a company that has no assets or has nothing in it, but it has no activities. The one again that always perhaps causes a little bit of problem is a property. So if you had a company that held the property, even if it wasn't charging rent, or all of the costs were borne by other group companies, again, HMRC are very reluctant to accept that is dormant. But again, you'd have to have what the point is. And somebody said, can I define what I mean by an associated company? I'm going to do that in a moment. This is all just to kind of contextualize what I'm about to talk about. So I am going to get onto that in a moment. We also exclude what are called passive holding companies. So if you have a holding company that has no assets other than a 51% subsidiary, no income other than dividends being received by that holding company, receives distributions, but then they are all paid out to its own shareholders, has no chargeable gains, has no management expenses, and makes no charitable qualifying donations, that will be a passive holding company, and that does not need to be taken into account. Now, I should say that whilst that is the definition of a passive holding company, it's not exclusive. So the legislation says it would include a company that meets all of those conditions. So you could have a situation where you didn't quite entirely fit within that, but you could still argue that you're a passive holding company. I think that there may well be issues with that, and again, it would be potentially something that the revenue would challenge. And somebody's asked a question, what costs could a holding company incur and still remain outside the associated companies count within a group? It's quite a difficult one because certainly, and I should say that this provision also was applicable in the old days when we had associated companies being relevant. So broadly, the question of costs tended to be one that the revenue didn't have a lot of wriggle room about. What I have seen with passive holding companies is situations where, for example, a holding company has got a property where it is being used by the group companies. They're not charging rent. All of the costs are met by the subsidiary company. And so whilst the asset is theoretically in the holding company, there are no costs associated with it. I must admit, I've always thought, that one was potentially, again, quite risky. But certainly, if you have got costs in a holding company, if you could get those pushed down into a subsidiary company, I think that you would stand much greater chance of it being able to argue that it's a non-trading holding company. Because the other point is, again, I suppose you're talking about what they're saying: accountancy fees, bank charges, companies' house fees, management expenses. I think things like bank charges, companies' house fees, I think you would probably be okay. Accountancy fees, again, you would probably be okay. I think anything else beyond that. So, for example, I was asked a question on one of these courses a while ago about, well, what about directors' remuneration? That I would think is a no-no. I don't think charging management expenses to a subsidiary company, again, I don't think that you could then argue that was a passive holding company. So I do think you have to, but I think you're right. The fees that they can't really get out of, the bank charges, companies' house fees, accountancy fees, I think you would probably be okay. But you really do need to keep them down to a minimum. And I haven't yet seen, again, what if you disallow the cost in the holding company? I don't think that makes any difference because what we're looking at here is basically arguing that your holding company is a dormant company because it has no activities. Now, the accountancy fees, the bank charges, the company's house fees are arguably the fees that are all going to be there because of the fact that you have the company simply exists. And therefore, I think that there is an argument to say that that is not indicative of there being any activity. Once you have things like directors' remuneration, you are charging management fees. That is much more indicative of the fact that there is an activity there. And I think disallowing those fees, they are still going to be there. You would be much better off having those fees charged elsewhere within a group. As I say, I haven't yet seen an inquiry from the revenue on this particular point in the new regime, but that was certainly how it sort of worked under the previous regime. Okay, so let's get to the nitty-gritty of this. Associated companies are two companies that are under common control, or one company that has control of the other. So you are within a group situation. Now, also as a bit of an aside, this definition now applies also for the purposes of quarterly instalment payments. When the previous split rate of corporation tax disappeared, they changed the definition for the purposes of working out whether you are caught by the quarterly instalment payment regimes, so that it only affected group companies. So associated companies did not have to pay, had basically the full £1.5 million limit before they had to pay quarterly instalment payments. It's now reverted back to associated companies. And again, I'll talk about that more in relation to the first example that we've got. So control, for the purposes of this definition, can be exercised by holding of share capital, voting rights, and entitlement to income or capital distributions. And that means that for these purposes, you could have different groups of people having control under different tests. And that means that when you are looking at common control, you may have different groups of companies that are being controlled by different tests. And there is no chronology of this. So if you have got control by virtue of share capital, we don't have to consider anything else. If there is control by voting rights, and that is what causes some of the complications. Control can be exercised jointly, and we will see that as we go through the example. And what we are looking at, and again, we will explore this in the example, we are looking at the smallest irreducible number of people who can control a company. So if you have two individuals, one who has 60% of the shares in the company and another person who has 40%, and we'll say for the sake of this example that none of those, they're all equal share rights, equal voting rights, equal capital and income rights. So effectively control in any one of those four tests is going to be exactly the same. The one who has 60% of the shares can control the company. So the smallest irreducible number of people that can control it is one. I mean, clearly the two together could also control the company because between them they have 100% of the shares, but the smallest irreducible number of people is one. And so it is that person, and it's only going to be other companies that that person controls that are going to be associated. So on the face of it, you might think, well, that's quite an easy, notwithstanding the complication of different rights associated with shares. But effectively, that is relatively straightforward. The problem we have is that in some situations, we have attribution of the rights of associates. So what we mean there is that associates are, we'll again look at definition in a bit more detail in a moment, but associates are things like your spouse or civil partner, your kids, your parents, your siblings, and the spouses of any of those people. So what we mean by attributing the rights of associates is that in some situations, you are treated as if you own their shares as well. And therefore, you can get control in a smaller number of situations. Now, that only happens where you have commercial interdependence. Now, we are going to look in a moment at what we mean by commercial interdependence, but let's just go through some very basic situations and consider whether or not you are actually going to have associated companies. So here we have husband and wife each own 50% of the shares in two companies. And fairly clearly, hopefully, you can see that they are under common control, because the smallest irreducible number of people who control that company is two, and it's the husband and wife in this situation, and there is no doubt about that. So they would be under common control. Now, because they have 50% of the shares each, if the husband had non-voting shares in one and the wife had non-voting shares in the other, such that in one case there was complete voting control by one or other party, that wouldn't make any difference, because you have met the test according to effectively share capital. Now, for the purposes of quarterly instalment payments, prior to 1st of April 2023, each of those companies would not have become liable to pay quarterly instalment payments until they had profits of 1.5 million, assuming they had a 12-month accounting period, because they were standalone companies. Now, if post 1st of April 2023, this was at risk, they would only have £750,000 worth of profits in which to be able to not pay quarterly instalment payments. Actually, I'll come back to that point in a minute. So that's a fairly straightforward one. Right, I'm going to ask you a question now. So this is the next example. Unmarried couple, each own 50% of the shares in two companies. So could we have the first poll, please, Helen? Are those companies associated? Yes, no, depends if they're commercially interdependent, notwithstanding that we haven't talked about commercial interdependence. So perhaps you can just answer those questions. Okay, so we have got 61% say yes, 14% say no, 25% says it depends if they're commercially interdependent. Okay, the answer to that question is yes, they are associated, because notwithstanding that they are an unmarried couple, we still have two individuals who jointly control those two companies. So doesn't matter who the two individuals are, whether or not you have a husband and wife or whether or not you have a married couple, doesn't matter. They are still under common control. Okay. Husband and wife companies yet again. 51% of the shares held by one party in one company, 51% of the shares held by the other partner in the other company. So Are those associated companies? Well, actually, they are not associated unless you have commercial interdependence, because the smallest irreducible number of people who can control that company in company A is one party. In company B, it's the other party. Now, as they are married, they are definitely associates. If they were commercially interdependent, the same person could control both companies because they'd basically be treated as owning each other's shares. But that would only happen if you were commercially interdependent. Now, if that was an unmarried couple, this situation would be different because unmarried couples are not associates. So if you had an unmarried couple where one in the party had 51% of the shares in one company, the other party had 51% of the shares in another company, they would not effectively be associated. And somebody said, could I expand on what I mean by commercially interdependent? I'm sorry if I've not been clear on that point. I'm going to talk about that in a minute. So I'm trying to go through this in a kind of logical way. So do you always look at the smallest number? If the husband had 51% shareholdings in both, then they would be associated. Yes, absolutely. So we're looking at having a common identity between the smallest group of people who can control the company. You don't have to have the same percentage, but you just have to have control by virtue of the percentage. Okay, so your chance to have another go. So if we could launch the second poll in the first company, 50-50 held by husband and wife. In the second company, they own the shares a third with their son or daughter. Don't want to be too sexist. And this is a grown-up child, I should say, although having said that doesn't matter. I've just realized that doesn't matter. It's anyone. So are those two companies associated? Okay, 59% of people said yes, 14% of people said no, 28% of people said it depends if they are commercially interdependent. Okay, so they are associated, regardless of whether they are commercially interdependent, because they are still under common control. Because the husband and wife control the first company by virtue of the fact they have 100% of the shares. They also still have more than 50% of the shares in the second company. So they have effectively 2/3 of the shares in the second company. It doesn't matter that that is a different number. So 100% in one company, 67% in the other. The smallest irreducible number of people that can control that company is two, and it's the same two people. Now, the mum and the son can also control that company, and the dad and the son can also control that company. So if there was a third company, I don't want to overcomplicate this, but if there was a third company where the dad and the son each had 50% of the shares, then company A would have one associate. So we'll say there's company C that's owned 50-50 by the son and the dad. Company A would have one associate because A and B can be under common control by virtue of the husband and wife. Company C would have one associate because company B could be controlled by the dad and the son, as could company C. Company B would actually have two associates because it's associated with both A and C. So that is where you get real complications. Okay, somebody said, does it matter if they own less than 51% each? I think that example, I don't quite understand that question. Perhaps you could just explain that a bit more. Sorry, I don't really understand that. Okay, so example 5. Husband and wife and 2 sons. I'm being a bit sexist again here. So they each have 25% of the shares. Now, those 2 companies would not be associated unless there was commercial interdependence. Because without commercial interdependence, the smallest irreducible number of people who control company A is 2. But company B, actually any 2 of them only own 50% of the shares. So you actually need 3 of them to be able to control the company. Now, if there's commercial interdependence, then any of those associates could effectively have shares attributed to them so that it could be 50-50. Now, that is another interesting point, because actually you could attribute, in the second company, you could attribute all of the shares to just one person. So actually company B could be controlled 100% by one person. And so you could say, well, they're not associated because company A is 2 people, company B is 1 person. But you only do the attributions to get you to the same shareholding, which I always think is really naughty. Okay, one final example. So if we could have the third poll here, please. First company is owned 50-50 by husband and wife. Second company is owned with 2 unrelated other parties, so they each own 25% each. Are they commercially interdependent? Sorry, are they associated? Ooh, right. 10% say yes. 61% said no. 29% says it depends if they're commercially interdependent. Well, the majority again got the answer right. So I am very heartened, actually, because often when I do these polls, the answers are not anything like as accurate as this. So I'm very impressed with the audience. So they will not be associated, even if they are commercially interdependent, because they are not related. And I should also have said they're not related, and indeed they are not business partners either, because that's the other thing that can be associated. So they would not be associated even if they are commercially interdependent. Okay, so let me just, we've had a few questions come in, but I will just go on and talk about what we mean by associates first. And then we will I'll go on and answer the question. So family members, parents, grandparents, remoter ancestors, children, grandchildren, and remoter descendants, siblings, and then spouses or civil partners and spouses of civil partners of all of those people. So it's quite a wide net, but doesn't include aunts and uncles, nephews, and nieces. So it is limited, but not significantly. Business partners, but not personal partners. And then trustees of any settlement of which any shareholder has an interest. Now, we have actually had one question in which asks about step people. And do you know what? I can't remember the answer to the question. So I'm just seeing if I could find that. Oh, isn't that great? I've been logged out of my... Okay, let's just have a look. And I can always come back to that question after the after the coffee break, the first coffee break. So I will perhaps come back to that in a moment. Okay, I have an unmarried couple. They have one company that they own 50 each, and they then each have their own company which they own 100% each. I don't think they are associated. Is that correct? Yes, it is correct. So that is correct where about that, because so okay, what is a business partner? A business partner, well, in fact, the legislation is quite vague. It just says a partner. It doesn't say anything more than that, but the revenue, who, after all, are responsible for interpreting this legislation, basically say that that means a business partner. So I think from the perspective of it would be somebody that you are in a formal partnership with. So it would be if you are in an unincorporated partnership, if you are in an LLP, I think that that would be the sort of scenario that we are thinking about. And certainly my experience is that actually that's the way that the revenue look at it. So just to look at that particular point. Someone has said that they didn't think that step relatives were classed as associated. Actually, I'm just looking at the legislation, and it doesn't specify within the legislation, which is section 448. It just says relative, which basically, so it just says brother or sister, which means that step siblings would not be taken into account. I will just check at the coffee break if I have time, to make sure that there's nothing else there, but it looks to me. Does a business partner include fellow directors who are not shareholders? No, it does not. So it has to be, when we're talking about partners, we are talking about partnerships. But that actually is a very good question, because that again is something that does confuse people. So, okay, let's go back to this question then. A company X has two shareholders, A and B, 50-50 same shares as rights. There is another company where Y, where one of those parties is a 100% shareholders. They are step siblings. They would not, those two companies would not be associated, because you would not be attributing the rights of those step siblings, even if those companies are commercially interdependent. So that is going to be relatively straightforward. I didn't think that step siblings were included, but there are so many different definitions within the Taxes Act for different purposes, that I have to say that I do, I'm always hesitant to be definite about these things unless I've checked. Okay, would a subsidiary company set up to hold a freehold be associated to the main company which holds the leasehold property and receives the rental income, or would it be dormant? I think a subsidiary company set up to hold a freehold would probably be treated as a dormant company if the main company receives the rental income, and effectively the freehold. And that does happen quite often, of course, because you can't have a freehold and a leasehold interest held by the same party. So it would probably depend on the exact nature of the arrangements. But I would have thought a subsidiary company just holding a freehold would probably just be treated as dormant. But again, I would have to caveat with that to say it would depend on the circumstances, I think. Okay, so let's get on to the question of commercial interdependence. So the legislation divides commercial interdependence into three categories. Financial interdependence, where one gives financial support to the other, or each of them has a financial interest in the affairs of the same business. And we are in a moment going to have a look at some revenue examples of what they mean by this, and actually probably makes sense to have a look at the example now. So this is, sorry, a little bit of a long-winded example, but basically you have an individual who's major shareholder and director of a company, and his son is the major director and shareholder of another company. And so the dad provided a personal guarantee for the borrowing, of the son's company. The companies are controlled by associated individuals, but they have no specific links. The guarantee was given by the dad in a personal capacity, and therefore that would not be enough to make the companies associated. The example does then go on to say, if the dad's company had made a loan directly, or had secured the loan by its own assets, then there would be financial interdependence, which is likely to cause those companies to be associated. I mean, it does say commercially interdependent. And even though that observation is not really made by the revenue in its examples, it would depend on the level of the loan and the size of the company. I mean, the implication is that, the loan is quite large relative to the company, but if it wasn't, then I don't think it would be enough to be commercially interdependent. But again, probably not the kind of argument that the revenue would make. The second one is economic interdependence. And I just think this is so woolly. I mean, to the point that I just think it's ridiculous in some ways. Companies are seeking to realise the same economic objective. Well, surely the economic objective that every business is trying to achieve is to make money. And you could have that same economic objective if you had completely separate companies. I think what the revenue are trying to imply by that phrase is that you've effectively split a business in two, and the economic aim is a single one. But I think that is capable of being, having very, kind of different connotations. The activities of one benefit the other. And again, it's not quite as vague as the first one, but it is almost. All the companies have common customers. And again, that, is completely irrelevant, I think, because you could have two businesses owned by people who have common customers, but doesn't make them economically interdependent. I think you would go back and say, well, just because we have common customers doesn't necessarily mean that we are interdependent, but it depends. So it is the one I think that causes the most problems. And indeed, the revenues example, I don't think doesn't really help that. And I should say that these are the best of the examples that are in the revenues manuals on these particular points. So here we have A and B, who are brothers who both built up internet businesses from modest beginnings when they were sharing a flat together as a student. A is a shareholder of a company which provides professional web design services. B is a shareholder of a company which provides graphic design services. Although their developing businesses benefited from the mutual exchange of ideas, especially in the early days, the brothers now have no involvement in each other's businesses, which operate entirely independently. The economic links between them are too tenuous to associate them. Well, again, if we go back to the first slide, it could very well be the case that, the activities of one benefit the other. And they could well have common customers, because it could be that, every website, the one brother does the graphic design work for it. And my understanding is that the vast majority of graphic design work these days is websites. So even though that example seems fairly unequivocal, I would say that it is probably a lot more nuanced than this one. Now, this final one is organizational interdependence, common management, common employees, common premises, common equipment. Now, the example here is quite complicated to start off with. And then once I've gone through this with you, I'm going to ask you to tell me whether you think that these are commercially interdependent. So Z is sole director of company P. He and his sons are, his son are directors and 50% shareholders of company Q. Basically, P is a trade wholesaler. Q has a retail counter, and they are selling items, DIY type items or trade items. Same premises, so all of the stock is out the back. The retail and wholesale sides are separate. Product ranges, stocking levels, and prices are different, so they might be co-located, but they are different. Separate phone lines. One is charged a commercial rental. They invoice a small markup. They divide the overhead costs. Employees are split, separate bank accounts, separate tills, etc., etc. Okay, if we could have the next poll, please. Question I want you to answer is, are they commercially interdependent? Yes, no, or need more information? Okay, yes, 53%, no, 29% need more information, 18%. So once again, and I'm very impressed again, the yeses, a slightly smaller majority here, but the yeses have won the day, because in Revenue's view, these are commercially interdependent. They say that the existence of one underpins the viability of the other. And whilst the two companies operate at arm's length, there are significant organisation and economic links such that the retail business could not operate without the wholesale site. I mean, I disagree. I mean, the retail business could be buying off an arm's length wholesaler. And so I think that that is quite a tough example. Now, again, a question that I get asked quite a lot is, if you had a company, the first example that we have, and I won't go back to that, but where we have, the second example where we have husband and wife, it's the third example actually, husband and wife, husband owns 51% of the shares in one company, wife owns 51% of the shares in the other company, in completely separate businesses, but both the husband and wife are directors of both companies. And the question is, are those companies actually commercially interdependent because of the directors? I mean, my answer to that question would be no. I don't think that they will be commercially interdependent just because they are directors. Now, obviously, that might cause the revenue to look at the situation a little bit more closely, but in general terms, I don't think that that is the case. So another question, two brothers own 35% each of the shares in company A, and then one brother holds 100% of the shares in company B. are these companies associated? Well, only if those two companies are commercially interdependent, because if they're commercially interdependent, the rights of the shares in company A would be attributed so that the brother that owns 100% of the shares in the second company could also be seen to be holding 100% of the shares or 70% of the shares, which is a controlling interest in the other. And so they would be associated if they are commercially interdependent, but not otherwise. Okay, so just from a very practical perspective, obviously, you know, it's self-assessment. You have to be asking your clients whether or not there are any associated companies, and obviously, they may well be reluctant to give you that information. They may ask why you're asking those questions. But I do anecdotally hear from my own accountancy clients that, you know, these questions are not going down very well necessarily with clients, particularly if, you know, you've perhaps just got a one-off company and you're asking, and it may well be that because the limits are quite low, you know, that it's not, you know, it's not an issue for a lot of companies anymore. How do you prove a negative if HMRC are adamant that you've got associated companies? There was a tax case around 15 years ago under the old regime where a UK company was controlled by a company in the Far East, or in the Middle East, sorry, that was owned by a trust and was all very secretive. And the UK company couldn't actually get any information about the holding of the ownership of the overseas trust and whether there are any other companies. And HMRC said, well, we're just going to have to assume that you've got enough associated companies so that you're paying the main rate of corporation tax. But the company did successfully challenge that. And the main issue is that the revenue didn't have any evidence either. So they hadn't been able to get any information about this company. So they were just making an assumption. And the courts basically said that that assumption wasn't good enough, and therefore the revenue couldn't just make that assumption now. But again, you know, the whole area has changed a lot in the last 15 years in terms of what the revenue are prepared to do. So before we have a coffee break and we get to the end of this first section, let me just talk about the case that I saw recently. What we had two individuals who owned a company 50-50. And one of those individuals then owned another company 100%. Or I think he might have owned it 70-30 with his wife, but he definitely controlled the company. So we had a person who had 100% of the shares or controlling interest in one company and then owned another company 50-50. Now, in that other company, there were no complications with, you know, voting rights. So obviously, if you've got a 50-50 company, but one of the shareholders has got a casting vote in the event of a dispute, then they might control the company because of majority shareholder and majority voting rights and all those kind of things. There were none of those complications. There were no loans outstanding. There was nothing. The revenue said they did do business together, those two companies. And the revenue said because they were doing business together, they were associated. But there were no circumstances in which the rights of either of the 50% shareholders could have been attributed between them, because they were not relatives, they were not business partners outside of the company. And I think the question that somebody asked earlier on about just being a fellow shareholder, that is not enough to make you associated. But that was the mistake that the revenue made. They were saying that those two companies were associated. And so I wrote a fairly long letter explaining the legislation to the revenue officer. And that was about 6 weeks ago. And they haven't come back to me yet. If I'd been the revenue officer, I mean, you know, unless there is an aspect of the legislation that I didn't understand, which is why I kind of went through it in quite a lot of detail when I was responding. But ultimately, I think that they have got that wrong. Okay, so it is 1 minute past 10. As I said, because it is on the warm side, we're going to have a couple of breaks. A couple of breaks of sort of 7 or 8 minutes each, so that we have the traditional sort of quarter of an hour that we would have in a normal 3-hour lecture. So I will be coming back online around about 8 minutes past 10. Hopefully that will give you time to just get up and stretch your legs and have a comfort break. So I will see you shortly. If you do have any questions, please feel free to pop them in the Q&A box in the break. Back again. Right, loans to participators. So what we're talking about here is the 455 position for companies. So as most people, I think, will be familiar with, Section 455 applies where a close company has loaned money to a participator, and the loan remains outstanding more than 9 months after the end of the accounting period. So a close company is one, as we've already mentioned, that is under the control of 5 or fewer participators. Most owner-managed businesses are going to fall within that definition. I mean, we do find situations where owner-managed businesses are not going to be close companies, but most of them will be. Now, when we are looking at control for the purposes of whether or not a company is under the control of 5 or fewer participators, we are always going to do the attribution of rights. So, I mean, obviously, we're talking about standalone companies here. So commercial interdependence between companies would be slightly irrelevant anyway. But ultimately, that's what we are looking at, is we would always make attribution of rights. So just to give you, a very straightforward and possibly very simplistic example, if you had, 10 family members, nice extended family, 10 family members each having shares in 10% of the shares each in a company, on the face of it, that is not under the control of 5 or fewer participators, because actually you need 6 of them to control the company. But as they're all family members, you are going to get attribution of the rights, which means that it will be a close company. I have to say that when looking at Section 455, I don't think I have ever come across a situation where whether or not it is a close company or not has ever been even vaguely relevant. So I don't think we need to worry about that. So we'll come on to those loans that are caught and everything else in a moment. But broadly, the Section 455 charge is going to be linked to the high rate dividend tax, which means that that has now gone up because the high rate dividend charge is now 35.75%, having gone up from 33.75%. The tax rate is linked to the point at which the loan is made, not at the point at which the charge crystallizes. So actually, it is going to be some way in the future before we are going to see loans that are actually going to be charged at 35.75%. Because even if you've got a 31st of March 26 year end, that's going to be 33.75%. 31st of December year end, it will depend when the loan was made. So, if you've got, particularly where you've got periods of account that straddle that 6th of April date, you will need to do a bit of granular analysis on loan accounts to just see what the date was that the loan was made. And obviously then in the future, and there's always scope for error to be made when the rates change, I have to say. So, again, just something that you do need to look at. Section 455 is slightly curious because the tax is actually repaid when the loan is repaid, although when we say that the tax is repaid when the loan is repaid, actually the correct the correct point is that it's paid 9 months after the end of the accounting period in which the loan is repaid. And therefore, you need to be slightly careful about timing of repayment. I mean, if you had a 31st of March year end where there was a historical Section 455 charge and you repaid the loan today, you're actually not going to get the tax back until after the 1st of January 2028, because that's 9 months after the end of the accounting period to the 31st of March 27. And given how slowly these things happen, I should imagine you could well be looking about summer 2028 before you get the money back, because the 1st of January is actually the first date at which you can apply to get the money back. So, again, it is not a straightforward one. HMRC are not typically minded to expedite repayment in any circumstances. So one of the points at which loans sometimes or Section 455 tax sometimes gets repaid is when a company is being wound up and the loan is effectively being written off as part of the winding up. And in that situation, sometimes you are just waiting for the repayment of the Section 455 in order to wind the company up finally. That is not even in that situation, the revenue are not even prepared to expedite it. So they are particularly obstinate about that point. And also, on a winding up on the point that the accounts need to be prepared as well. A lot of anti-avoidance provisions. So in very general terms, there are situations where a Section 455 charge can arise where it is not caught by the basic provision, where you have got money going to someone who is a shareholder. Indeed, that is something that you do need to think about. I would have to say that there are not that many scenarios where the revenue do apply this legislation, although I did see one a couple of years ago where the revenue were trying to apply the extended definition of the legislation in circumstances, again, where the person doing the inquiry obviously had really no clue as to how the legislation was supposed to work, which led to yet another one of my slightly passive-aggressive letters to the revenue. It's all I seem to do at the moment is write slightly passive-aggressive letters to the revenue. Anyway, specifically, if you are a partner in a corporate partnership, although those are, obviously less common these days, if a company makes a loan to a partnership of which it is a member, and where the other members of the partnership are participators in the company, that is treated as a loan to a participator. Or where the company makes a loan to a trust where the participator is a beneficiary. There is also a much more general anti-avoidance provision where a participator or an associate of a participator benefits in some way, but the loan is not otherwise caught. And again, that's a very woolly piece of legislation, but it is there. The other thing we have is bed and breakfasting provisions for repayment. Now, one of the things that we do see is people, what might be described as churning loan accounts. So they take money out of the company, or the company's incurring costs on their behalf, and that's debited through the loan account, and the loan account gets more and more and more overdrawn during the accounting period. And then after the end of the accounting period, once the accounts are done, either a salary or dividend is voted that brings that loan account back into credit. And that is done before the 9-month point, and the Section 455 tax never arises. And that just is repeated accounting period after accounting period. HMRC aren't too bothered about that. But what they are bothered about is situations where you apparently repay your loan account, but you don't. So there are two specific situations. That is where you repay the loan, but you then take the money back out within 30 days. So that is fairly straightforward. As long as the amounts involved are more than £5,000, you are caught. The second situation is where you take the money, so you repay the loan. You don't withdraw it back out again within 30 days, but basically, at the time you repay the loan, there are arrangements in place for that money to be withdrawn again at some point in the future. Bit vague, but kind of in the revenues view stops the abuse of that. Now, important to note that the bed and breakfasting rules cannot apply if the repayment or the method of repayment is taxable. So if you vote a dividend, if you vote a salary, even if you take that money back out to bring your loan account back into overdrawnness immediately, that's fine. One small wrinkle that I only became aware of relatively recently, because I was looking at this particular point for some other reason in the revenues manuals and came across this. If you are renting a property to your company and you credit the rent to your director's loan account, that could still be subject to bed and breakfasting, because whilst that rental figure, that rent might end up being subject to tax, it's not automatically subject to tax. Because it could be that you've got expenses that you're offsetting, etc., etc. So that, is definitely something that you need to be careful about. Now, the bed and breakfasting rules have historically only applied where in relation to the actual company itself. But in 2024, the Revenue changed the legislation. And this example, which was the one that was published in the guidance notes, kind of outlines quite well how this works. So you've got two standalone companies, or actually they're not standalone companies, they're group companies. So company A owns company B, takes £2 million out of company A, then takes money out of company B to repay company A, takes more money out of company B, and then basically just churns the loan back and forwards without any ever really paying it. And by the end of 2023, owes the company £15 million. So spending a lot of money. Prior to 2024, that would not have been caught by the basic bed and breakfasting provisions, but now it is. And so, again, you just need to be a little bit careful. I do very occasionally come across situations where people are sort of moving money between accounts to avoid Section 455, but it's not something I think that you would necessarily see very commonly. Okay, illegal dividends will be treated as loans to participators. And that would then mean that that is caught by Section 455 as a loan to a participator, assuming that the loan is outstanding more than 9 months after the end of the accounting period. But given that it probably takes a revenue inquiry about the loan, about the dividend, to realise that it is actually an illegal dividend, means that you are then normally automatically into a situation. So illegal dividends arise when you breach company law, often because there are lack of reserves. There could be other reasons. Obviously, purchase of own shares, which doesn't comply with company law provisions, can also breach these rules and be treated as a loan to a participator. So again, just quite careful in that particular one. And I'm going to sort of ask a question tangentially related to that in a moment. But had a question come in What should be the response where a client says they will repay the loan and you are preparing the CT 600? Would you complete the section at 455 section as a loan being repaid? And what date would you input? Today's date or the future date? I don't think you can put today's date in because that is incorrect. And it is likely that most software will not allow you to put a future date in. Now, if the client is saying they will repay the loan, then either you have to complete the section 455 section on the basis that they're not going to have repaid the loan, because at the time you are preparing the CT 600, they haven't repaid the loan, or you hold back the CT 600 until you know that they have repaid it. Because, as I say, putting today's date I think is risky because that is actually incorrect if they haven't actually yet repaid it. And I think that, I mean, the revenue have picked holes, effectively, they but for lesser reasons. Sorry, I lost my train of thought there. Yes, I would not be completing that until I knew, because the tax isn't actually due until 9 months after the end of the accounting period. Now, obviously, you don't need to file the return until that date. But it is a difficult one, and I do appreciate that it is not that straightforward. Now, I'm going to ask you a question here. There may be situations where HMRC will look to collect tax under Section 455 where there's extractive fraud. Now, extractive fraud is where the company is underpaid tax, but there is actually loss of cash to the company as well. So if you disagree with the revenue as to whether or not something that you've spent money on is an allowable deduction in your accounts, the company spent that money, and if the revenue disallow it, you will have to pay more corporation tax, but there is no extraction of that money out of the company. If you've got a restaurant that is not putting any of its cash sales through the till and not paying tax on that money, then that something must have happened to that cash, and therefore it is treated as having been extracted from the company. So next poll I want to ask you, what would the revenue do if they identify that? Would they look to tax it as employment income? Would they look to tax it as dividend income? Or would they look to treat it as a loan to a participator? Now, I know what it says on the slide, but what would your thought be as to what they might do, and indeed what they might think about, what your argument might be if they took that approach? Okay, so again, about 60% of people would assume that they are going to treat it as a loan to a participator. 30% would treat it as being employment income, 10% dividend income. In reality, there is no preferred alternative within the legislation, because actually the legislation doesn't cover that point specifically. The legislation just allows each of those options to operate. And in the past, there has often been a possibility of negotiating with the revenue as to what is actually going to happen. But now I think the answer is that no, they will go for Section 455 they would treat it as a loan to a participator. And I think that they do that because they get an immediate tax charge, but then also there is a potential tax charge in the future when that Section 455 is unravelled. Now, there has been some interesting discussions about different levels of culpability on company inquiries where you have a Section 455 position. So the penalty that you pay depends on whether the revenue would consider something to be negligent or deliberate. Where there is extractive fraud, so where people are deliberately taking money out of businesses, that is normally going to be deliberate because they will normally know that they are doing it. But there was a tax case recently where effectively the revenue, it was argued that because the revenue doesn't automatically take Section 455 tax, because they could treat it as dividend income, they could treat it as employment income. You can't say that somebody has deliberately not paid Section 455, and they did actually win the argument. It might be something that is useful in negotiating a settlement with the revenue in these cases. Somebody has asked, what is extractive fraud? As I said before, it is where somebody has, the company has underpaid tax, but that's because cash has not been correctly recognised and something must have happened to that cash. And it's normally assumed that it is extracted from the company by the main shareholder. I mean, there is this possibility in some cases that it could have been taken by staff, but in most cases, it is normally the director shareholder who is responsible for that. And there's another question come in saying, wouldn't that also be considered as fraud? I'm not sure I quite understand that question, so I don't know if you wanted to expand on that particular point, or I may well now have covered it. What's the name of the case I referred to? Do you know what? I can't remember off the top of my head. I will see if I can find it in the next coffee break. I think I've got an idea where it might be, where I might have the name of that case. I will check and see if I can find it for you. Leave that one with me. Okay, loan relationships is what we're going to move on to now. Okay, loan relationship rules were introduced way back in 1996, and I don't know why I necessarily always include that, but it was actually something of an experiment, which is what happens if we allow the tax treatment to just follow the accounting treatment. And yeah, it was an experiment, and an experiment which hasn't really worked, because actually HMRC got so fed up with what they saw as abuse of accounting that there's so much anti-avoidance legislation that it's very, very complicated. But the starting point is that you follow the accounts, and therefore there is only a tax impact if amounts are recognised in the profit and loss. There are sometimes situations where things that are recognised as other comprehensive income would get recognition, but that's quite rare. But as I've said, huge amounts of anti-avoidance provisions to be considered. And there is also a lot of other legislation which can impact on particularly the allowability of interest. So things like the corporate interest restriction, transfer pricing, if you were talking about overseas transactions, the hybrid mismatch provisions, where there is a deduction in one jurisdiction and no income recognised in another. So it is a very, very complex area. And once again, there is no chronology. Now, just going back to Section 455, somebody's asked me a question about intercompany loans, and I'm actually going to cover that point in this particular section. So leave that one with me. Right, so what is a loan relationship? A loan relationship is a money debt which arises from a transaction for the lending of money where a company is either a creditor or a debtor. So, where one company or one party lends money to another, and either party is within the charge to corporation tax. There are certain other situations where things are treated as loan relationships. Debts arising on trading transactions are not normally within the loan relationship provisions, but write-off of trading debts between connected parties do fall within the loan relationship provisions, and we'll come back to that point in a moment. The point about loan relationships and the debits and credits that are processed in the loan relationship provisions is that there is no distinction between capital and revenue. So it doesn't matter whether, if you write off a debt, you are writing off the capital element of a debt, the income element of a debt, it is still going to be processed and would be allowable, assuming none of the anti-avoidance provisions apply. The distinction is between trading and non-trading loan relationships. If you have a trading loan relationship, which is, one of the situations is going to be where you've borrowed money to use in your business, in your trade, then that is dealt with through the trading profit and loss account. So any debits affect the trading profits, any credits would enhance the trading profits. Non-trading loan relationships are anything that is not for the purposes of your trade. What you do is you net off your credits and debits, and then you end up with a single figure, which is either a non-trading loan relationship credit or a non-trading loan relationship deficit. There is also an extension of the basic provisions to cover derivatives and foreign exchange transactions, but we are not actually going to be covering that until later. Sorry, we're not going to be covering that. So money debt is a debt settled in money or is going to be settled by the issue or transfer of shares. Money is not defined, but takes its ordinary meaning, but it does cover repayment in a currency other than sterling. So fairly straightforward. A transaction for the lending of money, again, is probably relatively straightforward, but again, it covers instruments representing security for money debt, but it also covers things like unsecured loans, overdrafts, drawn down facilities, credit facilities, but not finance leases. Also now includes alternative financing arrangements, and normal commercial transactions would not normally amount to the lending of money, although they can do if the debt is extended. So the repayment period is more than commercial period. I think I've already covered that particular point, but actually questions come in. Are intercompany loans considered as non-trading loan relationships? Well, an intercompany loan would depend on the lender and the borrower. If you had two trading companies and one company loaned money to the second company for the purposes of its trade, it would be a non-trading loan relationship for the lender, assuming that they are not a bank, but it would be a trading loan relationship for the borrower. If you had a trading company lent money to a property company, then it would be non-trading in both companies, because property is not a trade. What property investment is not a trade. So it doesn't matter But for a lender, it cannot be a trading loan relationship unless you are actually a bank, or you are running a business which genuinely does loan money to other people and not just people that you are connected with. So again, hopefully that's relatively straightforward. Now, one area where we are seeing a lot, I should say that to a certain extent, the distinction between trading and non-trading loan relationships has become less relevant since 2017, when we had relaxation of the loss provisions, so that it is much easier now to offset trading losses off against non-trading credits, going forward, and so on. So actually, it's an area where the distinction is, as I say, is not as important as it might have been at one stage. So an area where we are seeing a lot of compliance at the moment is to do with unallowable purposes. Now, I acknowledge that, to be honest, the vast majority of the compliance is in relation to larger businesses, and in some ways, I think larger businesses are more at risk that this is a problem. But this legislation denies a deduction where a loan has been made for unallowable purposes. Now, it only denies tax relief on the deduction. It doesn't alter the tax treatment of the credit. So you do end up with a mismatch. So it is quite punitive legislation. Basically, a loan is made for an unallowable purpose where the money is not borrowed for the purposes of a business, or where there is a tax avoidance motive. And a tax avoidance motive is where the arrangements have been the main purpose, or one of the main purposes of the arrangements is the avoidance of tax. So, again, it is quite a wide one. What we have seen is typically problems in refinancing arrangements. So a couple of years ago, we had a case involving the QuickFit group of companies, where QuickFit was acquired by a PE house, private equity house, and there was a restructuring of the finances. And they had one company within that group that had a lot of non-trading loan relationship deficits being carried forward. So effectively losses. And so they increased the interest rate on loans that company had made, which increased the loan relationship credits, which utilized the loan relationship deficit. So the company paying it got a full deduction. The company receiving the interest didn't actually pay tax because of these deficits, and they reduced the period over which the interest was going to be used from 14 years down to 3 years. So it's quite a significant tax advantage for them. And that was found to be for an unallowable purpose, because now in that particular case, they were slightly stumped or slightly stymied in what they were trying to do, because they only increased the interest rate in relation to the loans for the company that had that deficit. So to a certain extent, it was fairly obvious what they were trying to do. And the case law that we've had has established various principles. You have to consider the purpose of what you're doing. Why are you doing what you are doing? It is not about the effect of what you are doing, it is why you have done it. And you have to look at wider group. The revenue will go through all of the documentation, and tax avoidance is very widely interpreted. Now, I think the area again where I probably see most questions is to do with write-off of impaired debt. Now, normally, if you write off a loan, there is a credit for the debtor company. They are better off because they no longer have to repay the loan. But there is a deduction, a debit for the lender. However, that is not true if companies are connected. And again, we will have a look at what that means on the next slide. If you are a connected company, you do not get a tax charge for the debtor. You do not get a credit so you don't get a debit for the creditor, you don't get a credit for the debtor. Now, whether or not that is beneficial, whether actually what you'd rather do is have a tax credit in the company that has borrowed the money, and particularly if they've got shed loads of losses that they can utilize to offset that, then it might be slightly irritating that you're not going to get a deduction for it. But again, it is what it is. Various ways in which the legislation operates in different ways, and I'll touch on that in a moment. And it is important to consider that it's important to remember that you have to consider the situation from both sides, i.e. from the debtor and the creditor. And there are a number of situations where actually you can get a mismatch in relation to the loan relations. Luckily, not something we see very often for smaller companies, but certainly for larger companies, it can be an issue. Now, we've said connected, and we have already spent an inordinate amount of time this morning discussing what it means to be connected for associated companies purposes, but throw that out of the window to an extent, because it's actually use of a much narrower definition, not the associated companies. It's still one company controlling or both of them under common control, but the definition of control is different. Control means the power to secure that the affairs of a company are conducted in accordance with your wishes. Again, either by virtue of shareholdings or voting rights or rights to assets on a winding up. But the big difference is that you do not attribute the rights of associates. So if you had a father's company lending money to a son's company, and that is written off, those companies are not in common control. So the dad's company would get a deduction, the son's company wouldn't get a tax charge. So, and certainly down the years, that failure to identify correctly that two companies are actually connected has caused, that they are not connected, has caused a number of problems. So that is hopefully not for this audience, but that is a bit of an issue in some circumstances. Now, you are only connected for the purposes of this legislation when both parties are companies. So if you had a loan from an individual who was a participator, which is a fairly common scenario in owner-managed business scenarios, there are complications, because if a participator has made a loan to the company and that is written off, there is going to be a credit in the company, there is going to be a tax charge in the company, because whilst they are connected for most purposes of corporation tax legislation, then there is going to be a credit in the company. And unless the company is insolvent or is you can argue that it can't repay it. It's probably unlikely that you're going to get tax relief for the participator. If a loan to a participator is written off, it's taxed on the participator as a dividend, but you don't get any tax relief in the company because there is specific legislation which states that. Now, so that is problematic. Now, I had a question in earlier on. What is your latest experience of situations where practitioners have shown a loan as an intercompany loan where the companies are not in a group? And for example, the loan is from a trading company to a property company, not a CIHC. What is HMR's view in terms of whether these are really loans to participators? Now, I have not really seen many situations. Oh, actually, no, I'm not going to comment on that. I'm going to ask for Helen to put up the next. Well, actually, I don't even know if it's Helen doing it. I'll ask the administrator. I do apologise if it's not Helen, to put up the next poll. And this is the final poll that you're going to have to look at this afternoon. So, trading company loans money to a company. The loan is immediately written off. Are there any tax consequences? And given the example that I have presented to you, you might be able to make an educated guess even if you don't know the answer to this question. And again, it slightly links in with the question that Craig has asked. Okay, bit more of a split decision. 36% of people say no, there are no tax consequences because they are connected parties. The write-off is tax neutral. 23% say the lender gets a deduction, but the borrower is charged. And 41% of people say that there is a tax charge on the shareholders. Well, what we are starting to see in the revenue, what I'm starting to see is that the revenue are challenging this situation. So, as I've said, debts between connected companies often potentially seed funding for investment businesses, and then the loan is written off. I am not seeing the revenue arguing that this is effectively a loan to a participator, because actually the loans to participators provisions, as I've already described them, in absolute term, a loan to a participator is not caught because it's only individual participate. Sorry, a loan to another company is not caught because it is individuals only. It's why we don't get Section 455 charges when we get loans between companies within groups, for example. And even though there is an anti-avoidance provision which says that if the participator benefits, then effectively you can still have a loan to a participator. But the fact is that the shareholder in both, even if it's a common shareholder in both companies, the revenue don't seem to take the view that that is automatically caught by the loans to participators provisions. But what they are starting to argue is that if the loan is written off fairly soon after it is made, it's not a loan because actually there was no intention that that was ever going to be repaid. Now, if the loan is written off fairly quickly, then it is very easy for the revenue to make that argument, because the fact that it gets written off very quickly is evidence of the fact that it was never intended that it was going to be repaid. And therefore, what they will be looking to do is actually tax that as an income distribution on the participators. So that is the line of attack that we are seeing. Now, the question I'm sure that you would then want me to answer is, well, how long does the loan have to remain outstanding before you stop being at risk from this particular point? I think that in any situation where a loan is written off, you could potentially get, and between connected parties, I think you could get the revenues saying, because the argument that they're making is, well, we don't think this was ever really a loan because you were never intending it, that it would be repaid. To a certain extent, that argument could be made however long the loan remains outstanding. And so what you could get is a situation where, you know, maybe you have a loan outstanding after 5 years, but the revenues say, sorry, it's written off after 5 years, but the revenues say, okay, I want all of the discussion about this loan at the time it was first made. And if there is anything in that correspondence that suggests that, you know, you were never going to be able to, you were never going to collect this money, and actually, equally, if you were going to wait 5 years to write it off because you know that there's a potential problem if you write it off earlier, I don't think that the revenue are necessarily going to be particularly happy about that. So, as I say, in response to Craig's question, I don't think it's the initial loan which causes the problems with the loans to participators provisions. I think it is the writing off. And I don't think that that is a small problem. I think it is a fairly significant problem. It is an area, it is probably the esoteric area that I get asked the most questions about in reality. There are also anti-avoidance provisions to cover the situation where companies either cease to be connected or become connected in terms of deciding how debt written off, particularly debt written off, is treated. So, for example, if you have two companies that are unconnected, so you've got one company, say, buying the other company. Actually, no, that's not a very good example. Let's just say you've got two companies that are connected. This is a better example, where you've got a parent and a subsidiary company, and the parent company have decided that actually they're not going to carry on financing this business anymore. They've loaned lots of money to the subsidiary, and so they impair the debt. No, it would be the other. Sorry, I'm getting very confused. I'm trying to make this. I'm trying to make this example up off the top of my head rather than having it written down, and I'm getting it wrong. The subsidiary company impairs the debt at the time that they are connected, on the basis that it's irrecoverable, and that they're not going to get a tax charge on it because it's connected. But then the parent company sells the company to a third party and then writes the debt off at the point at which they're no longer connected, so it can get tax relief. But what you have to do is consider the debt at the point of change. So if the debt is already effectively irrecoverable at the point at which you sell the company, then if you write it off, you are not going to get tax relief, because you wouldn't have got tax relief if it had been written off at that point. Sorry, I lost train of thought there. Basically, you have either deemed release of debt, you basically have deemed release of debt either when connection commences or ceases. There are a number of exceptions to that. For example, where there are debt for equity swaps. So perhaps if a bank takes a stake in a company such that they are becoming connected, and then they write off debt as part of that. Again, there are exceptions, but the conditions are fairly significant. There are also particular rules when businesses are insolvent. When a debtor becomes insolvent and goes into basically, you have to consider whether the connection is lost. Because if you say appoint a liquidator, connection would then cease, and therefore you would get normal rules being followed. If the creditor is insolvent, slightly strange situation, the creditor gets tax relief on the write-off, but the debtor doesn't get taxed on it. So again, it's just one of those issues that you need to be aware of. If there is there's questions come in. If there is a group that involves a property subsidiary and a trading subsidiary, and then the loan is never repaid, at what point do you deem it written off? Does it resolve the matter if you vote a dividend to the parent to repay the loan and essentially move the loan between the subsidiaries to the parent and the subsidiary? Sorry, if there is a group that involves a property subsidiary and a trading subsidiary and the loan is never repaid, at what point do you deem it written off? Sorry, I misread that. Well, if there is a genuine loan between two parties, it can only be written off by in writing anyway. So if you never put in place a formal document to write off the loan, it is never written off. It would be possible to effectively novate the loan up to the parent, but that again would have to be done in writing, or to vote a dividend to the parent to repay the loan. But if you don't do anything now, because you are following the accounting treatment, in that situation, it would be possible for either of those group companies to effectively impair the loan on the basis that it's never going to be repaid, never going to be collected, so that it's taken off the balance sheet. But if it's not done in writing, it's never actually formally written off. But because they're connected parties and because there wouldn't be any tax implication, then they could just simply impair it, and effectively it comes off the balance sheet. So it depends what they actually want to do with that, in terms of the actual connection. Okay, that quite neatly gets us round to 11 o'clock. So we will have another short break, again around 7 minutes. So I will see you shortly. Okay, let's get started again. Right, firstly, the question, what is the name of the case that I referred to about the different level of culpability for section 455 purposes? It's GoPaul, G-O-P-A-U-L. So hopefully that answers that question. Okay, so creating and breaking groups. I'm going to go through this fairly quickly. Because but I do just think it's one of those areas that does merit refreshing every so often. Okay, so creating groups of companies are normally going to be done by doing a share for share exchange. Now, obviously, groups are sometimes created by a company buying another company from a third party, but that doesn't particularly in itself give rise to any tax implications. So what I'm thinking about here is, share for share exchanges. If you have got one company, you can't gift the shares in that company to another and claim holdover relief. So what you would typically do is sell shares in your company to a new co or another company, and that company then issues shares in itself as consideration. So you are genuinely just swapping shares in one company for shares in another. It doesn't have to be a new company. It can be an existing company. And it could even be an existing company that you already own 100% of the shares in, so that your shareholding in the top co doesn't alter at all. That is all possible. And within section 135 of TCGA 1992, it's basically treated as a sharey organisation, and as most people will be familiar with, there is, if you meet the conditions, there is no crystallising of a CGT liability. Treatment is automatic if you meet the conditions, and really those are the conditions. The only situation is where you want to do a share for share exchange where there's less than 25% involved. So recently I had a case where individual had 23% of the shares in a company, and he wanted to put a new holding company above it because he wanted to get dividends out of that company to invest without paying tax on it, and he couldn't do a share for share exchange without the gain crystallizing, because the basic provisions didn't operate. Right, do you still need clearance for a share for share exchange? I'm actually going to talk about that now. So basically, the operation is limited to cases which are being done for bona fide commercial reasons. However, the terminology, the legislation has actually changed. And what the legislation now says is that you can only get share for share exchange treatment if you are not doing anything for the purposes of gaining a tax advantage. So we're actually moving away from a commercial situation to one where they're focusing on the tax advantage. And I'll give you a reason why. So there was a tax case 2 years ago, maybe 18 months ago, I can't really remember, where mum and dad, two daughters, two grown-up daughters, owned shares in a company. That company was going to be sold to an unconnected third party, but the girls had only been directors for a relatively short space of time, so they did not qualify for business asset disposal relief on their shares. So the deal was structured partially as a share for share exchange into the new company, or the company buying the shares, which was obviously amenable to this being done. But basically they inserted an extra bit into the deal so that the daughters could extend their holding period for BADR purposes. And HMRC challenged that on the basis that it was not being done for bona fide commercial reasons because there was a tax avoidance motive. And the first tier tribunal said, and in fact it was then supported by the upper tier tribunal, well, actually, the deal overall was commercial. And so just because there was a stage inserted into it, which was not, didn't change the overall commerciality of it. And so they've changed the emphasis of the legislation, which means that basically now there is you would not get clearance in that situation. Someone has said that my screen is not visible anymore. I'm assuming that that is not the case because I would have thought that I would have been told, and it looks like it is, but if there is a problem, perhaps somebody could let me know. Anyway, oh no, somebody said it's all good. Thank you very much. Effectively, there has been a change. So when you ask if you still need clearance for a share for share exchange, to be honest with you, at the moment, I think clearance is a good idea because this provision came in 25th of November, so it came in immediately in terms of the budget, and so we haven't really seen very much change in terms of the kind of situations where the revenue are prepared to give clearance. But I think at the moment, I mean, clearance is not mandatory in any situation, and I think that's probably quite important. So you never have to go for clearance, but I would say in most cases it's probably worth going for clearance, and probably go for clearance for transactions and securities purposes as well. So yeah, my view on clearance does vary. I mean, I do have situations where I think this is so straightforward. Do we really need to go for clearance? But the slightly cautious person that sits on my shoulder occasionally, I do often think it probably is worth going for clearance in most cases. But again, it's a judgment call. So for the shareholders, there will be no disposal, continuation of holding period, and so on. And normally it's fairly straightforward. Breaking up of groups is slightly more problematic. And what we are normally looking at is doing some kind of demerger. And actually, you don't necessarily have to have a group to do a demerger. You can, it can be done with a single company if you want to. There are three types of demergers that I'm just going to have a look at very briefly. Statutory demergers, liquidation demergers, and capital reduction demergers. Middle one is now relatively rare for reasons which I will explain. A statutory demerger is the best one if you can get into the conditions. And basically, what happens in that situation is that the company distributes either shares in a subsidiary company or assets directly from the company itself in specie to the shareholders. Because it is a distribution, you have got to have sufficient distributable reserves within the company. So you've got to meet the requirements of Companies Act. And then there are various conditions. If you meet those conditions, then the transaction will pretty much be completely exempt from tax. But those conditions are quite strict. You can never use a demerger of this type to get assets out of a corporate wrapper. So there are broadly three types of statutory demergers. The first is where you distribute shares directly to the shareholders. So this would be where you've got a parent kind of subsidiary situation and you distribute the shares directly to the shareholders, or you distribute either a trade or a subsidiary to a new co in exchange for shares being issued in that new co to the shareholders for the old company. So again, it's just one of those two situations. So if you're distributing assets, it has to be to a new co. If you're distributing shares, it can either be directly to the shareholders or to a new co in exchange for shares being issued to the shareholders. As I've said already, must have sufficient distributable reserves in both situations. The conditions are that the companies have got to be resident in the UK. Prior to the 31st of December 2020, you could be resident anywhere in the European Union, but obviously that was the date at which Brexit was ratified. You have got to be, all of the companies involved have got to be trading companies or holding companies of trading group, both before the demerger and after the demerger. The only exception to that is where the distributing company is going to be liquidated afterwards. So if you have a holding company with two subsidiaries and you wanted to get both of those subsidiaries out into the direct ownership of the shareholders, you could do a stat demerger for both shareholders, and then the holding company would then have to be liquidated immediately in order for the conditions to be met. So just need to be a little bit careful about that one. What you are distributing must be non-redeemable shares which represent the whole of the holding of the parent or the transferee company, transferor company, and the transferee company must have its main trade being on the carrying on of the trades transferred. So if you are transferring into a new company, if you're transferring assets into a new company, that company can't have any existing activities. So again, you just need to be a little bit careful about that one. The distribution must be for the benefit of some or all of the trading activities. It's not that it has to be done for bona fide commercial reasons. It is benefiting the trading activities. And that is sometimes seen as being not necessarily an easy area. But again, it's also not rocket science, but you have got to have a reason. It doesn't necessarily have to be a very complicated reason, but you do have to have a reason. There is also then, it can't be part of a scheme or arrangement for the avoidance of tax. It can't be to enable a chargeable payment to be made to a shareholder. And again, there's quite an extensive definition of a chargeable payment. It cannot be to facilitate either somebody getting control of the new company or indeed for it to cease trading or to be sold. So one of the most common situations where I get asked the question as to whether or not a demerger can be undertaken is where you've got a holding company with trading subsidiaries where the shareholders want to sell one of the trading subsidiaries and they understand that it will be covered by substantial shareholding exemption so that there is no tax payable in the holding company, but they want to get their hands on the money directly. So what they want to do is they want to demerge that out of the company, out of the holding company, so that they can then sell it directly and get BADR on it and have the money in their pockets. But unless you can think of a good reason why you are wanting to do it for other reasons, then it's not going to work. And indeed, even if the revenue did give clearance, if you managed to come up with some lovely explanation as to why you were doing this that had nothing to do with the fact that you were going to sell the shares, if you did then sell the shares, then within 3 years, then your demerger relief is clawed back. So it is quite a high jeopardy situation. Once again, there is clearance, there is a clearance process, and to be honest with you, with any type of demerger, I would think that you need to be going for clearance because there are so many nuances, there are so many questions that need to be answered that I would always go for clearance in a more complicated situation. If you get clearance for this to be treated as a stat distribution, it's an exempt distribution, so there is no income tax on the shareholders. There will be no capital gains within the company because it is either covered by substantial shareholdings exemption or it's exempt under a specific piece of legislation at section 139. It's a reconstruction for the shareholders and it's not a sale, so there's no stamp duty or stamp duty land tax. Somebody's asked, how long does a clearance take? I'm assuming as long as a piece of string. So HMRC have got to respond to a clearance application within 30 days. But that doesn't matter. That does not mean they will give you a decision in 30 days because they could just write out and ask you further questions. I think that, and this is my own view, because you either tend to get an almost immediate response. And I've had a same day response on clearance applications because you can email them in. You can email them. You don't have to send them a letter. I have had same day responses on clearances giving me clearance. So my understanding is, and this was sort of tacitly confirmed to me by somebody within the revenue, they use AI to scan clearance applications and look for particular criteria And if it gets passed by AI, basically you just get an email back, and that's why you get it back so quickly. In some situations, if they are going to be I've lost my train of thought again. It's because it's too hot. If they're going to ask you questions, those questions typically tend to come within about 7 to 10 days. If they're just thinking about it, then typically the clearance will come through after about 3 weeks. That's certainly my experience. But they do have to get back to you within 30 days in some way. Somebody said, I don't believe the distributing company can be sold either. Yes, I mean, you're absolutely right. Sorry, that slide should say that basically as part of a scheme or arrangement for cessation of the trade or sale, and that would be either the trade which remains or the trade that is sold. So yeah, you're absolutely right. And I'm sorry, I didn't make that quite clear. So this only works if you've got trades. So the condition that you've got to have all of the companies being trading companies means that you can only use a statutory demerger to split two trades up. And if you can meet the conditions, then my experience is that normally statutory demergers are fairly straightforward, because the conditions are so onerous that if you can go through and tick all of the conditions, then it's probably going to be the case that the revenue would give you clearance, but I would still always go for clearance. A liquidation demerger is where a company is liquidated under Section 110 of the Insolvency Act, although don't be fooled by the reference to the Insolvency Act, because actually it's got to be a solvent liquidation. And then the liquidator effectively transfers assets from the company in liquidation to a new co in exchange for shares in the new co being issued to the original shareholders. It's not an income distribution as it's part of a winding up. But these days, a capital reduction demerger would normally be preferable. Sometimes people want to try and go for a liquidation demerger if you actually don't really want to demerge. If say it's a cash-rich company and you want to wind up the company and get the cash out and get the ADR, but if you were trying to do that, you'd still have to get clearance from their revenue, and so you'd have to have good commercial reason for doing that. So that is not necessarily going to be straightforward. It is a cap of distribution, but will be treated as a reorganisation. Any capital gain in the company will either be covered by Section 139 or indeed in some cases SSE. It has to be a scheme of reconstruction. And again, it must be done for bona fide commercial reasons. So again, it is subject to prior clearance. And the definition of a scheme of reconstruction is on the slide. It's not really complicated. Most are going to meet that. So let's talk about capital reduction demerger. Capital reduction demergers have become possible since, I think, 2016, might be slightly earlier than that. And it kind of achieves the same as a liquidation demerger, but without doing a liquidation. So it does save liquidators costs, but it also saves degrouping costs. Now, sometimes in order to do a liquidation demerger, you've got to move assets around the group. So a long time ago, and this was probably the first liquidation demerger I ever dealt with, we had a company owned by 4 siblings, as I remember. They'd inherited this company from their father, and they'd fallen out. And what they wanted to do, this is before you could do capital reduction demergers, what they wanted to do was separate out the two portfolios in order to split them, do a demerger and split them. And the only way that we were going to be able to do it was to do a liquidation demerger. And what they'd done before they took any advice was that they transferred one portfolio into one subsidiary company and another portfolio into another subsidiary company. And then they came along and said, right, we want to demerge these. The problem was that because there'd been an intergroup transfer of property, they had to wait 6 years before the CG degrouping charge would go away. And they had to wait 3 years between the stamp duty degrouping charge going away. Must have been after 2003 because it was after SDLT had been introduced. Um, so in doing that first step themselves, they'd slightly shot themselves in the foot, although if they demerged it directly from the holding company, there would have been SDLT on the transfer. So it still wouldn't have worked to save the SDLT. So what capital reduction demergers do is that it effectively, you kind of liquidate half of the company. But because you're not liquidating the other half of the company, you're not effectively getting degrouping charges. Anyway, let's have a think about an example. Actually, the example I'm going to give you is not a group of companies, but it's a single company which has got a trade in it and then has got cash and a property. So the first stage in this situation is to put a holding company above it using a share for share exchange. And then you move the property and the cash up into the trading company, into the holding company. Now, sometimes we do that because we haven't got sufficient distributable reserves to undertake the capital reduction. So if you already had a holding company subsidiary structure, but you didn't have enough distributable reserves in the holding company to do the capital reduction, you could create those by putting a share for share exchange in place. Then you partition the shares in the new holding company. So you've got A shares and which give you entitlement to everything, and then B shares which give you entitlement to the subsidiary company. You then make a declaration of insolvency and you resolve to reduce the capital by transferring, so it's the A shares give you entitlement to the subsidiary, but the wrong way around. Basically buy back the shares in the holding company in exchange for a transfer of shares in the trading company, transferred to a new company, which then issues shares to the existing shareholders. So you've basically split out the business into two transactions. There's no degrouping charges because the assets that you've transferred stay within the group. Share for share exchange is dealt with under the provisions that we've already seen, and the capital reduction is a reorganisation. Once again, you would need clearance from the revenue, and again, once again, you would be wanting to do that in this situation. I recently did this in a situation where the shareholders wanted to sell the trading company. So they demerged the trade. They'd identified a purchaser who was actually an existing employee of the company, but that person could not afford to buy the property that the company was trading from. And the existing trading company also had shed loads of cash in it as well. Now, I was incredibly skeptical about whether or not we would get clearance in that case because we were going to be selling the company. And after the initial meeting that we had with the client and their existing accountant, the client contacted the accountant and said he didn't like me because he thought I was relentlessly negative. I mean, I thought I was just being realistic, but apparently I was relentlessly negative. I mean, he wasn't exactly the most cheery of people. Anyway, there we go. We did get clearance. The revenue did ask a lot of questions. And I think what was in our favour was he was retiring, absolutely retiring. The purchaser was borrowing money from the bank and the bank did not want him to buy the assets from the existing company. They wanted him to buy a clean company. So both of those factors were very much in our favour. It did take a bit of time, but we did get clearance for it in the end. So never say never in these situations. I do just think, as long as you can do it without being relentlessly negative, I do think, sometimes it is worth going for clearance. Okay, a couple more questions. In my experience, have HMRC challenged whether a company that holds an investment property is carrying on a business for a scheme of reconstruction or just has a passive investment? Interesting question. I have never had a problem where the investment property within the existing business, within the existing company, is being rented to a third party. I entirely accept what you're saying, that it could be that it was seen as a passive investment, but I've never had that problem. The situation where I have had a problem has been where you have got a property that is being used for the purposes of the trade, but the trade is being split out in isolation. But interestingly, that was not challenged in the case that I've just referred to. Now, the case that I've got where the revenue challenged it in the past was a long time ago. And I think it was probably a liquidation demerger rather than a capital reduction demerger. So I don't have any recent experience of the revenue challenging that. Now, I have to be honest with you to say that I don't deal with a lot of these cases because they're an absolute nightmare. Yeah, I've not got any recent experience of them causing that as an issue. Does the demerger have any implications on BADR timeframes of holding shares? Because the share is a reconstruction within Section 136, when you get issued shares in the new company, they basically inherit the BADR holding period. But if you are intending to sell the shares quickly, I mean, you would need to make sure that you are telling the revenue that in the clearance application. Now, obviously, these things always come out of the blue, or do sometimes come out of the blue. But yeah, you do get continuity of treatment. We have a situation where 3 equal 20, so I'm reading this question. We have a situation where 3 equal 25% shareholders are rolling the shares up to a new holding company, but the other one is receiving cash for his shares via a purchase by the new holding company. We believe we can still elect for rollover relief for the 3 doing the share for share exchange and also claim stamp duty relief on their transaction, but have to pay the stamp duty on the cash sale for the exiting shareholder. I haven't touched on the stamp duty side of things because I've kind of felt that was a bit beyond the scope of this session. But I should mention that I'm doing a stamp duty and stamp duty land tax session with K3 in the autumn. And I think that might well be the one where we don't get as many sign-ups as I often do on these courses. It is going to be a really interesting and practical course. Can I just say that now? I've just to sell myself a little bit. Anyway, you're absolutely right that you can elect for share exchange treatment for the 3 who are rolling into the new trading company, the new holding company. That's absolutely a problem. The stamp duty relief will not apply, and you will have to pay stamp duty on both the cash element of the sale and the market value of the shares that are going across as well. What I'm just going to do is just send you my email address privately. If you want to get in touch with me about that, please do come back to me directly. You have a problem when you do a share for share exchange, and I probably should have mentioned this. But when you do a share for share exchange, you have to have complete mirror image of the shareholdings in order to avoid paying stamp duty on the share for share exchange. So it's quite a difficult area. Okay, now I am going to just go through for the last 20 minutes or so. I'm just going to go through a few tax cases. Now, this one effectively. Sorry, before I do that, let me just with the stamp duty on the point just raised, is the valuation set out in the share for share clearance? No, you don't. Well, you don't have to. Normally, you wouldn't need to put a valuation into the share for share exchange clearance. But if you wanted to do so, it would be market value. So again, it would just be a question. I mean, the revenue probably wouldn't agree the valuation, even if you put it in the clearance application. What you have to do is you have to send the transfer form into HMRC, into Stamps Office, and then they either agree or challenge the valuation. It's not very often that you get Stamps Office challenging valuations in those situations. Right, case law. This first case is on the face of it a little bit peculiar, but I think it's quite an interesting case to consider, really, because I see similar cases being forwarded to me for tax planning ideas, and I'm not a great fan of aggressive tax planning, mainly because I just think the fallout is too much trouble. I'm anything for an easy life. I mean, I obviously do tax planning for my clients, but I'm not looking to promote aggressive tax planning schemes. But that's just, the decision I've made within my own practice, and I wouldn't criticize anybody who does, but I think you do have to be realistic. This is a case where we had two profitable companies who told their directors and employees that they were going to pay them pensions. But this was going to be an unfunded, unapproved retirement benefit scheme. So they weren't going to put money away to pay this pension, as might be considered to be a prudent idea. Basically, they were just saying that when you retire, we will carry on paying you. And I think most people would be fairly cynical about whether or not that was worth the paper it was written on. But anyway, they calculated what contributions they would need to be paying to a pension fund in order to meet these pension contributions. And it represented between 80 and 100% of the pre-tax profits. And they claimed a deduction for that on the basis of a provision being put through the accounts. Now, provisions are only tax deductible if they fall within what used to be FRS 12. I don't know if it's still FRS 12 because I'm not an accountant. They knew that this was a fairly aggressive tax planning scheme because it was actually notified to the revenue under DOTAS, which is the disclosure of tax avoidance schemes. But basically, HMRC disallowed this provision. They disallowed the provision on the basis that any liabilities incurred for the purposes of a tax avoidance scheme are not expenses that are incurred wholly and exclusively for the purposes of the company's trade. So in order to get a deduction for any cost, you have to prove that it is being the cost is being incurred wholly and exclusively for the purposes of the trade. And what is often overlooked is that the legislation, which I want to say is at section 54 of CTA 2010. I don't even know, it might be section 30, or maybe it's 34 of, anyway, it's around there in the legislation, basically says you don't get a deduction for any cost which is incurred for the purposes of a tax avoidance scheme. So even if this was a legitimate provision, although that was questioned by the revenue, even if this was a legitimate provision, it would not have been tax deductible because it was incurred wholly and exclusively for the purposes of the scheme, a tax avoidance scheme. Now, they also made an argument about that this fell within specific provisions that were introduced after the EBT, Employee Benefit Trust debacle, but it was accepted that that wasn't really relevant. The revenue won at both the first tier tribunal and the upper tier tribunal. This is a case that went to the Court of Appeal. And the Court of Appeal, found that basically whatever the company said this was not motivated by some altruistic desire to provide a pension for their staff. This was purely to save the corporation tax. And again, that was reinforced by the fact that the amount of contributions that they were making was not at all linked to how much the benefits might be in the future. They said it was, but actually they couldn't produce any evidence to demonstrate that. And it was just all about at the level of the profits. It was there were other arguments made, but they were all dismissed. And that was the end of it. And again, it was fairly straightforward. One that I had referred to me a number of times a few years ago was to do with GDPR. The argument was that everybody was effectively at some point or another going to fall foul of GDPR, which are the data protection regulations that came in, 3 or 4 years ago. And they were so obscure and so woolly that eventually everybody was going to fall foul of GDPR and everybody was going to get sued by one of their clients. And therefore you could put in a provision for failure to comply with GDPR. And I always thought that was really quite dodgy, and never really thought it was worth even thinking about. Although, whether people did do that, I don't know. The next one is to do with capital allowances. Now, the definition of what represents plant and machinery for capital allowances purposes is complicated. The 2001 Capital Allowances Act has been in place, since 2001, 25 years. But we still get tax cases about interpretation of the rules even now, which I think is a very interesting observation to make, really. But one of the things that you can do is get the costs, ancillary costs of installing plant machinery. You can get capital allowances on it. Anyway, 4 companies involved here. Expenditure of £46 million, so big numbers. These were 4 companies that were involved in building and operating offshore wind farms. Now, the actual, do you know what I know? Don't know what they're called. Can't think what they're called. The bits, the propellers. Anyway, you know what I mean. The bit that actually generates the wind, that is caught by the wind and generates. My mind has gone completely blank as to what they're called. That's clearly plant and machinery. But the question is whether or not the blades. That's right. So thank you very much. And the bit that the blade sits on is definitely going to qualify for capital allowances. But the question is the extent to which preliminary costs were ancillary costs that were available for capital allowances. So again, the building of the foundations on the seabed are again definitely going to be eligible for capital allowances. But what the company was claiming capital allowances for were things like the surveys that they had to do, because there's no point in siting a turbine. That's what they're called. There's no point in siting a turbine which is in the middle of a shipping lane or is in the middle of a bird migration lane, because effectively, if you get a lot of bird hits, these, not only is it very messy, but these things have to be repaired. It's a bit like the damage that a bird can do to an aircraft engine, basically. They had to do lots of things, but they also had to do surveys of the ground, the seabed, look at things like, weather patterns. They had to look at currents in the sea and lots of things. And they claim capital allowances on all of those costs. The first 2 tribunal allowed the geophysical and geotechnical surveys. The upper tier tribunal disallowed all of the costs on the basis that they were too remote to the installation of plant. And then the Court of Appeal said, no, you can have everything. So we get to the Supreme Court on the basis that the three earlier courts have all made completely different decisions. So again, that demonstrates how complicated these factors are. Supreme Court basically went back to the upper tier tribunal. They believed that whilst installation costs are allowable, in this case, it was just way, way too remote. And therefore, they couldn't have any of the costs. Now, effectively, HMRC have actually started to look at consulting on this particular point to see whether or not the legislation needs to be extended. So they have acknowledged the fact that this is a difficult area. So we may well see this changing. The next one is another case in front of the Court of Appeal. And again, whilst the specific technical point here is quite a remote one, I do think it raises an interesting sort of perspective in relation to double tax treaties. I often say that tax cases are interesting because I'm a bit of a tax nerd, and I do apologise for that. So because I do appreciate that most people don't find tax as fascinating as I do. Anyway, so we are starting to see an awful lot of situations where the revenue are challenging the terms of double tax treaties. The UK has the most double tax treaties of any country in the world. I don't know how many we've got, but we do have the most double tax treaties. But when we have, and the name gives it away, a double tax treaty is there to avoid a taxpayer having to pay tax twice, but it also determines who has taxing rights. So from the perspective of the revenue, they don't want to give up their taxing rights if they don't think they have to. And there are various situations where people have to withhold tax on payments being made to other people. And the most common situations where you have to withhold tax is interest, dividends, and royalties. Anyway, this case involved debt, so interest effectively. So when Lehman Brothers collapsed in 2008, 2009 as part of the credit crunch, they collapsed on the basis that they couldn't service their debt, but they were not insolvent. So anyone who was owed money by Lehman Brothers knew that they were going to get the money, but they didn't know how much they were going to get. And there were a lot of people who couldn't kind of sit around and wait to get their money back from Lehman Brothers. And so a secondary market developed in Lehman Brothers debt. And this was an Irish company that bought debt from a BVI company, as it happens. Now, because they were an Irish company, there is a provision within the UK Ireland Double Tax Treaty that says a UK company, and Lehman Brothers was a UK company, can pay interest to an Irish company without withholding tax on it. However, you can't do that if the main purpose of the arrangements into which both parties have entered is the avoidance of paying interest. And HMRC's argument was that this Irish company had only bought this debt from the BVI company because they knew or they thought that they could get their interest without deduction of tax. And so the revenue were trying to argue that the main purpose of the arrangements was, to take advantage of that exemption. But both the first tier tribunal and the upper tier tribunal basically said that was a load of tosh, and therefore it went to the Court of Appeal. So the argument that was made by the company was that they could offer a better price to the BVI company for the debt because they were going to receive the interest without deduction of withholding tax. So they were prepared to pay more for the debt because of the withholding tax exemption, but that didn't mean to say that the transaction had been done, excuse me, I've got hiccups, that the transaction had been done, or the arrangement, the main purpose of the arrangements was to take advantage of the exemption. It was just a commercial decision which influenced the commerciality of the overall transaction, and the Court of Appeal agreed with that. So it's like saying, well, I'll buy something through the business because I can get the VAT back. Although you do still have to use it for the purposes of your business in that situation. But, you know, again, it's a similar scenario. So they won the argument. But as I say, we've had a number of both corporate and general tax cases where HMRC have been arguing about interpretation of double tax treaties. Now, the next case is about whether or not trading has begun. Now, whether or not trading has begun is relevant for various things. This was a case that involved EIS, and I think probably EIS is the one where it is most critical. But, you know, again, it is relevant in other circumstances as well. Now, the reason it is critical for EIS purposes is that if you issue shares on which you want the subscribers to get EIS relief, you basically get you have to start trading within 2 years. So two companies issued shares to subscribers on the 1st of April 2016, which meant that they had to commence trading by the 4th of April 2018. Now, there is a get out of jail free card where you are undertaking qualifying research and development, because as an alternative to trading, if you can prove that you start to undertake qualifying research and development within 2 years, then you are treated as trading. Now, these were two companies who were going to build power stations. I think they were building power stations to be fueled by alternative fuel. So whether they were burning waste or they were burning biofuel, I don't know. But that's what they were going to do. But by the 4th of April 2018, whilst they were building the power stations, they hadn't started to produce them. They hadn't started to supply energy. And the first tier tribunal looked at that, decided they weren't trading, and the company lodged an appeal to the upper tier tribunal. Basically, one of the companies did actually have some contracts in place. So they had signed a contract with the National Grid. Basically, on that basis, they'd started building the power station. But by April 2018, they were very definitely not generating electricity. And the other company hadn't even started building. So on that basis, neither of them were trading at the relevant date, and therefore the company did not qualify as an EIS company. Now, things like BADR, substantial shareholdings exemption, the definition of trading includes any period where you are undertaking pre-trading activities. And in a case about business asset disposal relief, or I think it was actually about entrepreneurs relief rather than BADR, the courts did find that starting to build the fires, actually, did they accept that building it was pre-trading? I think that they decided that starting to build it was not pre-trading, but putting in place contracts, even if you actually hadn't started to generate electricity, was enough to be pre-trading. So in that situation, it might be different. And again, I think that sort of highlights the fact that, and again, this came up when we were talking about associated companies earlier on, and whether or not step children and step siblings were associates for the purposes of the legislation. I think that does highlight that one of the very unfortunate things about the tax legislation is that there are different bits of legislation, different interpretations apply for different bits of the legislation. Again, that is something that, is very different. So again, I think that, is the message. We do need to make sure that we are reading the legislation. I'm not going to go on and talk about the next slide because, again, it is a very complicated situation. I don't have time to cover that now. But thank you very much for your time today. I hope that you found it useful. There will be a recording of the webinar and will be available from next week. Hopefully that is as useful. And I think I do have another one session. I think it's, as I say, stamp duty, stamp taxes. It is going to be more interesting than you might think it is. But as I say, Marie did mention at the beginning the other courses that are coming up. So thank you very much for your time today, and goodbye.